This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk here on this Friday, July 1st. Great to have you with us once again. Thanks for making us part of your day. I'm your host, Jesse Allen, as we are into a holiday weekend now in front of us with July 4th on Monday. Again, thanks for joining us here today and making us part of your day as we look at another wild, volatile market trade here on this Friday. You can find us online, markettalkag.com. That's our home on the web. All of our streaming sources, radio affiliates, the latest news of agriculture, and much more. It's all online, markettalkag.com. Well, as we head into the holiday weekend and we got the USDA reports behind us yesterday, we saw more red numbers on the screen on Friday. Another volatile day. And here to walk us through what we're seeing and talk about it, let's say good afternoon to DuWayne Bosse of Bolt Marketing. DuWayne, great to have you back on the show, sir. And we were chatting a little bit before we went on the air. Not the funnest way to go into a holiday weekend here today with the way this grain market traded.
No, kind of a really nasty day when you think about it, Jesse. I mean, I went in today thinking, all right, you got a 3-day holiday coming up. Nobody's going to want new positions. It should be fairly quiet. I had a really rough day yesterday, like you mentioned. You would assume you have a little bit of a bounce back recovery in the grains. And boy, right from the opening at 8:30, soybeans had a different idea. And down about 60 cents here near the lows and didn't finish very strong. And a really tough day, you're right.
Well, I'm going to start. There's a lot of things we can unpack and talk about, but I'm going to start with a question that may be a little blunt, or maybe even some would say naive, but I'm just going to go with this. Do you think the bull market run is over for a while, or do you think this might be a temporary setback in this bull market run that we've seen? Just thinking about all the chart damage and everything else we've seen the last couple of weeks here, do you think the bull run's over, DuWayne?
I think the bull run is over, Jesse. I really do. Kind of felt that way going into that report, thinking you had 2 strikes left almost in baseball terminology. You had that report that could have gave you something really bullish if both corn and soybean acres were down sharply. The last strike we've got comes on Tuesday, and that's the weather. We're going to need a very hot and very dry forecast to get this market back up and these funds excited. And I want to mention the funds because that's why I think it's over. I think this is fund liquidation, getting out of long positions they built up going into this hedge on inflation. That's changed into a fear of recession now. And prices in China for soybeans there have dropped sharply. But yet their crush margins have not improved. That means their demand is just down. Now, yes, people still have to eat, even in a recession, but, how much do they go out and eat? And it's a money flow thing, Jesse. We like it when the funds overinflate this market, right, and get us a lot higher than we should be. But we have to be ready for them to exit like this. And I got to be honest with you, even with a mixed forecast on Tuesday, I think this fund liquidation continues. Therefore, I think the bull run is over with.
Well, as we unpack things a little bit more, you look at yesterday's USDA numbers, the acreage numbers, soybean acres obviously was the big surprise. That was kind of one of the headlines that caught the trade. The grain stocks numbers were pretty much in line, which was surprising. Usually that's where we get a significant change, it feels like, in that June report. You look across those USDA numbers yesterday, DuWayne, what stood out to you just on the surface? I have a few thoughts, but what stood out to you?
Probably 2 things. One, the soybean acres being lower than expected, but that didn't shock me. Hearing up here, I mean, this is my backyard, the prevent plant area, sadly. Our North Dakota growers were telling us they don't want to plant late corn. They'd rather plant late wheat, basically. So they planted as much corn as they could on the good ground. So they got those acres in, and then they went back to wheat. What happened, Jesse, is we just ran out of time and dry dirt to plant all the beans. So the bean acres ended up short. So that was one surprise for the markets. The other one is in that stocks report. you mentioned it's amazing how dead on that stocks report was. So why is there a surprise there? The surprise was the on-farm stocks were higher than anyone anticipated, especially for corn and beans. And that's much more bearish than we'd like to admit, because what happens there is end users, like an ethanol plant for corn, is going to say, oh, so you've got more corn than we thought. And all of a sudden, that really high basis that we've seen might start to go away, along with a futures market that's dipping. And then farmers may puke and panic and sell, and therefore the bull market is over again. And it might be over in the cash market as well.
I'm glad you brought that up, because that on-farm storage caught me by surprise too, as I kind of dove into the report more. And I would have to think, DuWayne, that's just a case of, farmers basically, for lack of a better term, having enough money in the bank and saying, I don't need to sell right now. But to your point as well, if we start to see that cash basis erode, what's that going to do to a farmer's mentality with his marketing plan right now?
Yeah, it's kind of interesting. There's a lot of psychology actually involved in marketing and farmers selling grain. Your first point is 100% right. With ERP payments, disaster payments, and really high, prices, farmers sold what they wanted to, and they don't need the cash. Therefore, they were really strong holders. And no one in the Midwest really feels like they have a perfect crop right now. If you got rains and you're sitting with beautiful waist-high corn to chest-high corn and beautiful-looking beans, you'd sell that last remaining stuff you have in the bin. Nobody really has that. So without needing cash and not having a perfect crop coming, they're just not selling it. Also, what happens to farmers, and myself included here, you see $8, and if you didn't sell for that and the price dips back down, you say, well, next time it gets there, I'm going to sell. And that seems to be almost the nail in the coffin sometimes, and then it really erodes. But the depressing part of what happens, you could sell today and it's actually still a very good price. But if this market tanks next week and you get that third strike I was talking about with it now getting a bullish forecast, weather forecast, then farmers will actually sell more than likely. And that'll keep more pressure on this market, sadly. So the market found out yesterday there's more grain to be sold, basically.
DuWayne, another thing that I saw as I dove more into the numbers from Thursday, the acreage side for corn, some of these changes or lack thereof on acreage state by state was quite puzzling. You look at, Iowa up 100,000 acres in corn. All right, but Minnesota up 500,000 acres, according to USDA. And then on the flip side, absolutely zero change reported in Illinois, Indiana, Nebraska, Michigan, Pennsylvania on there. Some of those numbers on the corn acreage side, if you look at it state by state, were very puzzling to me.
The funniest one, we talked about it earlier, is the no change in some of those key states. It's like, really? No change at all? And if anything, I think that could have been a little bit higher, actually, because what happened since March 31st, Jesse? This corn market actually went quite a bit higher. I mean, during the entire spring and during the planting season, you had over $7 in D's corn. For a while, you had above $7.50. So to me, the market did its job and made sure we kept those planters running, even in non-ideal conditions. I got to tell you, from around here in northern South Dakota and North Dakota, we got some crop that doesn't look very good because we mudded it in. We know it doesn't work, mudding crop in, but when beans are 15 and corn 750, I'll push it. And we did that this year. So we need a rain like everyone else does up here, but we got the acres planted, and now the great debate about the yield will rage on moving forward.
Looking at charts, I know I mentioned this earlier. We talked about a lot of chart damage has been done here in corn, wheat, and its soybeans. On the corn side, December corn going down through the 200-day moving average. I would have to think that probably opens us up to the downside. Just one has to wonder, where could that next downside target be, DuWayne?
When I look at December corn, a line I drew, it was back to late April, early March, and a low of 578 actually. And maybe saying 5 sounds crazy, but we're at 608 here now, so it's not that far away, sadly. And I mean, you get down to the 550 areas, you basically trace this whole rally that we've done. But remember, we're still talking 5. We're still talking a good price. But with those acres, up just a little bit from the trade estimate in corn, our ending stock is really not that scary. as long as we can yield a 179. And remember, 179 is actually probably a little bit under a trend line yield. And I'm still at trend line for corn. I mean, we'll see next month what we start adjusting that yield at. And then if you mix in this recession talk I'm talking about, if the global demand is just not as high as we thought it was going to be, then you don't export as much. And all of a sudden we go from thinking we're running out of corn to close to 2 billion possibly. So believe it or not, 578 might be too high for D's corn too. I think the more important thing to look at is this afternoon's Commitment of Traders report. How long are the funds? Because obviously the charts look bearish. The weather might look bearish come next week. If they don't want to be long anymore, how many more positions do they have to get out of? I think we got to tie that in when we're looking at where we could bottom at too.
Very, very true. DuWayne, let's talk wheat as well. I know we broke through some 200-day moving averages there and some chart damage there as well. I mean, wheat still good numbers, but well back to, basically where we started there. 8s on Chicago wheat, 9s in KC wheat and spring wheat. You look at the wheat complex as a whole, anything stand out to you? I should say either positive or negative right now, DuWayne.
I know, kind of a depressing interview we're putting on right now, isn't it? I wish I could talk more positive, but I guess as far as positivity, I can say, September Chicago wheat at 851. I'm seeing around that 840 is actually one spot of support. I had drawn a line in the sand a while ago thinking that would be the worst case, but it seems like just a blink of an eye and we've dropped down to these levels. Like I said, we've erased all the Ukrainian war premium we've had in wheat. And I really felt like for Minneapolis wheat, for the new crop, I thought $10 would actually be a good place to find a low here and start building a premium back in. But this is why they say you don't catch a falling knife. We're now down to 950 in Minneapolis wheat, and right now the trade action tells me don't buy it. Stays short. This market looks like it's going to keep going. Maybe when it comes to wheat, maybe we got to go down low enough where we find our own demand. This past week, obviously we've dropped over $4 off the highs in wheat, but we saw the big buyers like Egypt step out and buy some big cargoes. I think their biggest purchase in over a decade this past week. Of course, it wasn't from the U.S., was it? But they're out there buying. So they feel like it's been enough of a break in prices. It's worth them going out and locking some of that prices in. Maybe we just got to get to a point where they actually buy some from us. And that'll be your hard support line in wheat. So right now, sadly, I don't know if I see much support. I think we got to see a purchase sometime.
On the soybean side as well, a little more there. I know you brought up some of that China demand and some of the prices falling in China. I look at the bean market, obviously down hard today. Bean meal has been fairly strong, though, the last couple of sessions. And I wonder if that could be something that maybe gives us some support to this bean market as we get into the month of July.
Yeah, well, keep reaching, Jesse. We'll find something bullish. Actually, right? You're right. It has been better support recently. Maybe that it has a little bit that the soybean oil has come off the highs, and it was the soybean oil that actually drove this soybean meal crush demand higher. And the meal's been better supportive. And with the cattle and hogs out there that we've got, we should have decent meal demand. But I'm afraid that the short-term pop in meal was just that. I'm afraid it was a little bit short-term. I think that's not going to be able to hide from the selling pressure that is going to get drugged down from everything else.
Well, DuWayne, I think overall to wrap up our depressing grain conversation today, you mentioned the term, don't catch a falling knife. And I like the term, stair step up, elevator down, whatever cliche you want to use, but it all comes back to managing your marketing plan and managing emotion, I think, as well. If you're looking at things and maybe you haven't made as many sales as you wanted to, and you're seeing prices come down now, it's all about managing, and it's all about perspective, isn't it?
It really is. And don't do what's so easy to do on a day like today. It's easy to shut the screens off and I'm done with it. Okay. But come Tuesday morning when we're live again, if these markets are down on a bearish forecast, it's okay to be aggressive. Let's just say you haven't done anything up to this point. You're still going to sell at nice profitable levels right here. And actually, you're probably going to be right around the average hedger, as he sold on the way up and now is back down. He's probably at his average price. So if you walk in today, did nothing and sell, you're probably okay. And I guess that's what I would encourage people to do. Don't just sit there and watch it go down, or say, well, I can't sell because it's down 20. When this market goes down, like you said, elevator shaft down 20 can be just the start of the day. So be aggressive, look at your spreadsheet. If you still are making money, which I know you are, it's still a good sale here. And if the funds are still heavily long, if you learn that in the commitment to trades report, maybe keep selling, because they may push it down further than it's supposed to go fundamentally.
All right, DuWayne, let's shift gears to livestock. I think we can find some positivity there today. Some green numbers on the screen. You know, the lean hog and live cattle complex was kind of dismal here all week. It really just struggling, but finding support today. Feeder cattle higher with the cheaper corn prices. So you take a look at things. Maybe start with the hogs. It was a bit of an interesting reaction to the quarterly hogs and pigs numbers, and I wondered today if it was more spillover support from cattle or a delayed reaction to a neutral to friendly report on Wednesday.
That was a neutral to friendly report. Yeah, the hog and pig report is what you're talking about. We're just not expanding that herd, and if anything, they keep retracting just a little bit. The problem with the hog market right now is a strong seasonal tendency to top out in the cash market here and start to trend lower from here on out. And we're trying to rally, but I'm just a little bit nervous about that market there. A little pop in the cash today, but maybe looking at some of those deferred contracts, maybe it's worth hedging there. We might extended forecast. If you talk above normal temps in July for feedlots and areas where the finishing barns are, I mean, maybe weights won't be quite as heavy. That's the bullish twist to the hog market, but I sadly, I can't get too bullish that market either. I promise you, I'm not always a bear, but I just am today, I guess. But that strong seasonal tendency to go lower, I'm afraid, does affect this market, and you'll probably see that moving forward.
How about the cattle market? Looking there, as I mentioned, good work, good move in the feeder cattle with the cheaper corn prices. That spilled into the fats today as well. August taking the lead month there in live cattle. Any thoughts with the cattle trade as we head to the holiday?
On the market, I'm bullish here. It's weird, Jesse. I wish I had a lot of strong fundamental reasons. Well, there are good fundamental reasons, and let's talk about that first. The cash market's white hot. Box beef are strong. We've had a little bit of a pullback this week because all of the purchases for the July 4th holiday were already done. But it seems like packers are pretty desperate for cash cattle. And then you talk to guys in the industry, it sounds like the kill cattle market is just white hot. You just can't find them. We've talked almost for a couple of years about this cattle market and a herd retraction, and we're going to see a rally coming up soon. And I think we're finally there. The odd thing is, I talked earlier in this interview about a recession, right? And the market's pulling down and money flow leaving. I got this goofy feeling that the money flow might actually go into the cattle market during this early part of this recession, which makes really no sense. I mean, it should go down, but it never really rallied when the stock market rallied that much. And it never had this big inflation trade either. And it's weird, you flip the calendar to July, and it's almost like these hedge funds had a plan. They were going to sell out of beans and they were going to start buying livestock, because cattle took off right away at 8:30 this morning and made all of us kind of go, oh, wow, look at that go. I understand August is at a big discount to cash, but that doesn't matter for another month at least until we get into delivery. So little surprised at the market today, but it kind of have this gut feeling that maybe cattle market can be bullish here. And we talked about technicals. I mean, we broke a lot of technicals on the grain side, but actually are breaking them on the positive side when it comes to cattle above some 100-day, 200-day moving averages. Looks strong.
Well, I think that's a good spot to wrap it up here today, DuWayne. And if folks need a little advice and need a little help with their marketing plan, I know they can reach out to you. They're Bolt Marketing very easily. Can't they do that?
Absolutely. I got guys trying to reach out right now. It seems like I apologize about that. Yeah, they call us here directly, 605-448-2365. And they can always check us out online at boltmarketingllc.com.
Well, with that, DuWayne Bosse of Bolt Marketing, appreciate the time, sir. Enjoy the 4th of July weekend, and we'll talk to you again soon.
Sounds good. Thanks, Jesse.
That's going to do it for Market Talk here on this Friday, July 1st. Find us, markettalkag.com. I'm Jesse Allen. Have a great and safe 4th of July weekend.